Retail sales rose at a muted 0.2% pace in the month of June, coming up short of Wall Street estimates and showing slowing growth from last month. So what does this show about the state of the consumer? Matthew Luzzetti joins us now, Deutsche Bank Securities Senior Chief U.S. Economist. Good to see you, Matt. Thanks for being here. So retail sales, I got to tell you, Matt, it is a confusing time, right? You have consumer confidence that's doing pretty well. Retail sales kind of meh. How do we synthesize all of this?
Yeah, so certainly from a consumer confidence perspective, we've seen a rebound in the past 2 months.
Right.
But from a level perspective, it remains well below where we were from 2019. So there's not necessarily this big disconnect there. Actually, within the data this morning, I would have taken an optimistic or more positive tone. If you look at retail control, which is the underlying details of the report, strips out some of the volatile items like gasoline, it was actually stronger than expected with some upward revisions. So all told, I would take away from the consumer, it still remains resilient at this point.
Do you like what you saw in terms of some of the categories? We saw growth in, as you teased this out earlier, furniture, home furnishings. So there was a decline in department store sales. What do you make of the categories?
Yeah, I think we've all, over the past year, been anticipating that you're going to see good spending, particularly in those household furnishing items, coming back down to the pre-COVID trend. The idea was, as you've gotten beyond kind of that big pent-up demand that we had, that you would see a reversion to norm. You really haven't seen it in a lot of those categories so far, and you're seeing some consistent strength there. Previously that was a source of upside surprises for inflation. As Fed officials were surprised by upside inflation, they're talking more about the goods items. It does appear like that inflation impulse is probably behind us, which is an important development from the Fed.
So how long does the consumer remain strong?
Key question. We have a key input into that has been thinking about excess savings that households have. We still think they have above $500 billion in the aggregate, but that becomes increasingly skewed towards the upper end of the income distribution. I don't take it as being a key input, perhaps, into the spending that we're seeing at the moment. As we look ahead, we expect that the labor market's going to be decelerating, that you're going to see jobs gains decelerating. As that excess savings is drawn down on top of that, you've seen rising delinquency rates. So I think there's early signs of some slowing in consumer spending. But no doubt, many people have been looking for it over the past several quarters, and it really hasn't come through as much as anticipated.
Let's talk about student debt for a moment as well, and how it's going to feed into consumer spending, and not just consumer spending, but the big picture, the bigger picture. I was talking to a friend recently who has kids who are recently out of college, who has their friends have a lot of student debt, and he pointed out that not only if you have to now make these debt payments that you didn't before, that means you're not going to be buying whatever or going on whatever trip. Yeah. But maybe also that money might have gone into the market, and now it's not going to be going into the market. So what's your big picture view on how big that impact's going to be?
Yeah, so if you quantify it, we think it's about $60 to $70 billion annualized from household income, which is not trivial. It's certainly a big amount. If you put it as a share of total consumer spending, it's probably 0.3 to 0.4%. So it's meaningful. It's particularly impactful, obviously, for those households that have student debt, and we've seen some stresses for them. So if you look at auto delinquencies for younger households, they're actually well above where they were from a pre-COVID perspective. And so I do think that's an important potential headwind for consumer spending. At the same time, we see the Biden administration trying to take other actions in order to dent or kind of mute the impact, have it come in more gradually. And so it does not appear to me like that's going to be a key source of downside at the moment, probably in Q4. It may take a little bit more time for that to be impactful.
Can I ask you about what your perspective is on where we stand with regard to recession risk? And the backdrop being that we got a note out today from Jan Hatzius over at Goldman Sachs. So maybe your arch nemesis, I don't know. But they've reduced their probability that a recession will start down. They've reduced it from 25 to 20% prediction, so definitely lower. One, where do you stand on expectations for one? What's your probability first before we kind of dive a little deeper into this?
Yeah, so we've had, going back to last April, we've had a baseline call for recession at the end of this year. We've kind of termed it as a mild recession. We've kept that as our base case. I do think that you've seen developments recently that have been supportive for the soft landing camp, that give us maybe a wider avenue there. Number one has been inflation. Last week's inflation report was important not just because you saw a 16 basis point print for core CPI, but the underlying details were supportive. You saw that core services ex shelter component was softer. We had goods disinflation coming back. As we look over the next several months, used car prices are going to be softening. As we just talked about, perhaps that impact from student loan debt coming back might not be as severe if it gets spread out over time. So there are a few items there that I think are certainly helpful from a soft landing camp perspective, and markets are definitely responding to that over the past several weeks.
One of the interesting things that Hatzius points out in his note is that the yield curve inversion is not necessarily the predictor it once was, and he lays out a number of different reasons, including raising the question of whether it's just wrong, investors are wrong. How do you think of that indicator versus other ones that you track?
Yeah, it's typically, historically, very reliable. Over time, there's a lot of shifts that take place that always cause us to question, I think, whether it's as reliable as it's been in the past. I think the key today is not necessarily if you look at the 2's 10 slope or 3-month 10 slope, but if you look at what the market is pricing in terms of Fed rate cuts, what is that telling us? Is that telling us that the Fed is cutting because a recession is imminent or is happening over the next 6 months? Or is it happening because inflation is going to come down and the Fed is sitting at a 5.3% Fed funds rate and they think neutral is closer to 2.5%, and therefore they can glide path down? I think that's the key source of uncertainty about the yield curve at the moment. I would focus on the rate cuts part, and I think that there's equal, or at least both parts are being played in there, that there are heightened recession risks, but at the same time the Fed may be able to cut rates simply because inflation falls, and they don't want to become increasingly restrictive over time as inflation falls.
It's so funny when you talk about like soft landing, because we had a conversation earlier with Liz Young about how some people are defining soft landing, with some defining it as a mild recession, some defining it as no recession. I want to ask you, in terms of the Fed funds rate and what you're expecting from the Fed through not just next week, but through the balance of the year. Are you expecting 2 more hikes?
We're expecting 1. We're expecting that they hike rates next week. Certainly have a lot of conviction in that going into the blackout period. Every Fed official basically signaled that that's a most likely outcome. But we've expected that to be the last hike of the cycle, that they don't deliver on the 2 hikes that they saw in their June dot plot. Mm-hmm. And that was basically thinking that you're going to see inflation come down a bit faster over the next several months, but also that you're going to see some evidence in the growth and labor market data that things are softening. So our baseline right now is the Fed raises rates by 25 basis points in July. It's the last hike of the cycle, and they basically sit there until they can cut rates eventually, either because we see a recession build and the labor market weaken, or because inflation is coming off.
Just to get a little perspective here, we keep talking about recession. We've been talking about recession for a long time now. And we behave as though like there's going to be this blaring sign when it happens. It's the instant we enter, you're in a recession. And that's not really how it works.
That's true.
How are we going to know that we're in a recession? And when will we know, relative to when the recession begins, that we're in a recession?
I think it's all about the labor market. So I think the key for markets, for the Fed, is not whether we get negative GDP growth in a quarter or 2. We had that in the first half of last year, and the Fed did not blink at all. They continued with 500 basis points of rate hikes. So the only key, I think, is do we see the labor market weaken materially? We've done research in the past about what the best real-time indicator is for recession, and it tends to be continuing jobless claims.
Okay,
and we get that on a weekly basis. They're little revised, and so it tends to give you a very strong signal about what's happening with the labor market. Those were looking weaker several months ago. They've topped out over the past several months, have shown some moderation, and are certainly not obviously showing signs of recession at the moment.
Okay, is there a particular number that you're watching, a level?
So when we had done the analysis,
Yes.
It was always on a change basis. And I think that was important because there were structural changes over time. On a change basis, we have cut through all of those recession indicators. But that's because we were coming from historically low levels. I think I would want to index everything to where it was in 2019, because it's a question of,
that makes sense.
Are you seeing the labor market soften from historically and extraordinarily tight levels just to a level that looks more normal from a 2019 perspective, or is it outright weakening? Initial jobless claims look like an outright weakening. Continuing claims do not at the moment.
All right, we have to leave it there. Thank you so much, Matt Luzzetti, Deutsche Bank Securities Chief U.S. Economist.